Hello, my name is Fred Amrine and welcome to another program regarding student loan repayment. Today's topic is interest capitalization on student loans. This topic is being sponsored by Repay 411, a company that specializes in student loan repayment and information around that topic. Let's begin. So one of the things you need to be concerned about is the reasons why your student loan balance could be increasing. This is a function of which loan repayment method you select, and the ones where what a term called negative amortization or interest capitalization occurs are under the income-based repayments methods, and they are income-based repayment, income contingent repayment, income-sensitive repayment, and the new one, pay as you earn. All these methods are based on your income level and your debt level being what is a feasible amount, or a calculation using either 10 or 15% of your disposable income that the government allows you to pay. Because of this, the entire amount may not cover the interest that's being charged to that loan. So an example would be if you are only paying $100 and your interest is $150, you're not paying the $50 through interest. Now, depending on what your student loan mix is and things like that, this could have what's called negative amortization to the loan, and depending on the type of loans that you have, this may add additional debt onto your current loan balance. So you need to be really concerned or aware of that process, since it may increase your debt over a period of time, especially if you're early on in the process, where it could impact, affordability of a house and things like that when you get married, or if you get married down the road. So let me give you a quick example of how this works. Say we have a student, a recent graduate, that has $30,000 worth of debt. Their monthly payment should be $327 based on the standard 10 pay. If now we decide to go with one of the methods, and we're going to use income-based repayment, and there's a whole lot of things that could factor this, how many subsidized loans you have or what the amount is, the interest rate on all of your loans, all these things have factors in this calculation. So you can see in this case where we have an interest charge of $140, our monthly payment is $116, so we have a shortfall of $24 a month. Again, this is just an example with some numbers, which would mean that we would be increasing our loan balance by $288 a year, which doesn't sound like a lot, but depending on your situation and the amount you're able to pay, you will need to work through these numbers to understand what your debt increase will be if you decide to use one of the income-based repayment methods. So what are the things that could impact your interest capitalization if you have a change of income? The term that the process uses is financial hardship under the income-based methods. So you need to be aware that maybe this isn't a long-term decision. It does help you stay current and avoid any defaults, which again, at all costs you want to do. These methods are really designed for those situations. It may not be a good long-term decision in this methods. Again, you'll have to see what your career path and things go. If you should have a change in payment plan, so if you decide that maybe this isn't a best method, if the interest could be capitalized, again, depending on what method you're using, there are different rules under each of those four that we mentioned earlier on. If you go back to school and you move back into deferment, actually that's considered a change in plan, and the interest would be capitalized in that situation. Career changes. If you should maybe be working in a nonprofit or for the government, and you move now where you're not going to qualify for loan forgiveness, this could also impact your long-term solution to paying your debt. Changes in your life, such as marriage, or if you want to purchase a home, because of the debt-to-income ratios that maybe sometimes look at, or if you decide to have children and start working part-time, all of these things could impact how you're going to be repaying your loans and things like that. Again, if you should get married or something should happen, or you are married and you get divorced, your tax filing status could actually impact how this interest could be capitalized or changed. So how do we avoid the increases? One is to contact your loan servicer And again, or you can contact somebody like Repay 411 to maybe help you understand your numbers and find the best solution for you based on your repayment plan you selected. So again, at the very beginning or as you process through your life, you may need to change plans. When you make that decision, if you don't do proper plan on the front end, this may cost you additional money in the long term. Typically, the interest is capitalized on an annualized basis. Again, the four methods have different rules. You'll need to work with your servicer or work with someone that understands those. If you are going to qualify for loan forgiveness, it may not be a bad thing that this happens, because if you're qualifying for the public service award, or maybe you have a teacher's forgiveness program that you're under, the negative amortization may not impact you as much. But if you change careers and you're no longer qualified because they are a 10-year, or depending on the program, could be a 10-year planning tool, you may not be able to complete that situation. And again, if you feel that you need professional help to work through this, please consider Repay 401 as a solution. Again, if you have further questions or you need more information, please visit our website or our blog to see if there's additional resources available to you. Thank you and have a great day.